All right, in this video, we're going to learn a little bit more about materiality, audit risk, and then audit evidence. And so these are three main things that we should know going into any audit. And this also sort of helps us understand, what are we able to do and what are we able not to do because of other factors, okay? And so when we do an audit, we want to go in and we want to do the best job possible. We want to get all the evidence possible so that we can say that the financial statements are clean. But the problem is that's not always the case, and that's not always possible with the amount of data that we would have to go through. And so these three things we have to think about when we're doing our audit from a high-level perspective. The first one is materiality. Now, the definition according to FASB is that materiality is information is material if omitting it or misstating it could influence the decisions that users make on the basis of the financial information of a specific reporting entity. Okay? And so the way that I like to think about materiality is what would actually change your decision, or how much would it have to change your decision in order to make an impact on your decision, okay? And so the example that I often like to use is pretending you're a college student. So you're a poor college student, you're just getting by, and you have $100 in your pocket. And then you're walking through campus, and somehow, some way, that $100 falls out of your pocket on the floor and it's gone. And so the question that I usually would ask is, would you be mad about losing that $100? And the answer is usually yes. I mean, that's $100. You're a poor college student. You really need that $100 because you're trying to get through school and not spend a ton of money. Okay. Now, if we flip that question around and we said, okay, pretend you are a millionaire. You're walking down campus or you're walking down the street and you lose $100. Does it really matter too much that you lost $100 when you're a millionaire? And the answer to that usually is no. I mean, if you're a millionaire, the $100, it's as much as you don't want to lose it, it's not a deal breaker. It's not going to make you mad for the rest of the day. And so if we look at materiality, that $100 for that college student is very material. Losing that $100 is very, very important, okay, to that individual. But $100 to a millionaire is not material at all because they've got so much more money. So material at the end of the day is what would cause the end user to make a different decision on something if it was changed, okay? And so that's why information is material, if omitting it. So if we don't put it in your financial statements or misstating it, so losing the $100 versus losing $100 when you're a millionaire, it could influence decisions that users make on the basis of financial information of a specific reporting entity. Now, the auditor's job with materiality is how big of a misstatement could there be before it significantly affects the user's judgment. So for instance, again, we can kind of go back to the millionaire and non-millionaire. But let's say we have a company that does $10 million of revenues, okay? And let's say they round cash from $255,642 to $255,600, okay? Which means, technically speaking, their financial statements are misstated by $42 because they've decided to round to the nearest 100. Is that material in the eyes of the user? Probably not. Okay? Now, what could be not material for this company may be material for another company. Now, this is going to be a little bit of an offshoot, but let's say that you have a company that does $300,000 in revenues. That $42, although only $42, could be material for this company. Okay, it probably isn't, but it could be. Okay, so it's important to know that what might be material for this company may not be material. Sorry, what might not be material for this company would be material for this $300,000 company here. So that's what material says. So our job as an accountant or as an auditor is to figure out at what point or what number would something be material, either by itself or in aggregate. So if we add up all of the material differences, would it be over this aggregate amount? Okay. Now the reason also that we want materiality is it helps us figure out what the nature, timing, and extent of audit procedures are. So for instance, if materiality was $5,000 and their bank account is $500, that's really not material to us because it's below $5,000. Nature, time, and extent, we might decide, you know what, we're not going to audit the cash account because it's only $500, okay? And it's below our materiality. So anything below our materiality, we can decide not to test, or we can decide, hey, once we test it, if it's below that, then we can say the entire balance is still good and valid and appropriate in nature, okay? So that helps us do that. And remember, materiality, the biggest thing about materiality that it helps us with is cost versus benefit, okay? What's the cost of getting more information, and what's the benefit of that, okay? So if our materiality was, let's say, $5,000, okay, versus $300,000, we would have to get more evidence usually for the $5,000 than the $300,000. Okay, because all of the small balances we might not have to look at. So anything between $5,001 to $300,000, we wouldn't have to look at that company that has a $300,000 materiality versus the $5,000. So cost versus benefit. What's the benefit of grabbing balances underneath $300,000 and coming up with an opinion? And it probably is. It would cost us too much just to get that incremental benefit of knowing that it's correct. Okay. So that's what materiality helps us with. The second thing that we need to look at is audit risk. And audit risk is the risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. And that's from AU 320. And so with audit risk, we're saying that, you know, there's a legitimate risk of auditing financial statements. And that legitimate risk is that we could come up with a wrong opinion. And the question is, how much risk did our audit cause us to make that wrong opinion? Now remember, in audits, we're trying to give reasonable assurance, not absolute assurance. We talked about it in a prior lesson. We want reasonable assurance. If we want reasonable assurance, we're going to have some audit risk. Because we're going to have some audit risk because we're not looking at auditing every single transaction that went into the accounting system, that went into the account balance, that shows up on the financial statement. If we actually audited everything and checked everything and redid everything, we would have no audit risk. But our job is to get reasonable insurance because the cost versus benefit for that incremental assurance is not worth it from a cost perspective. And because it's not worth it from a cost perspective, we're not going to have absolute assurance. We're going to have reasonable assurance. Therefore, we're going to have audit risk. Now, we're going to learn more about this later on, but if we want to lower our audit risk, we're going to have to lower our materiality. Why do we want to lower materiality? Well, let's say that the materiality was supposed to be $300,000. If we want more assurance that all the balances are correct, and less audit risk, so less risk that we're going to give an inappropriate opinion, then we're going to have to lower this. And if we lower this $300,000 to, let's say, $50,000, we're going to have to collect more evidence because we can't go over that $50,000 misstatement. And any balances that are over $50,000 but under $300,000 now become subject to an audit versus before when maybe we didn't have to audit because underneath that materiality. Okay? So the audit risk is the risk that we're going to give them a clean opinion, but in reality their financial statements are not clean at all. Okay? And so we want to reduce the ability of audit risk, but at the same time we can't get rid of audit risk unless we audit everything and get absolute assurance. Okay, so that's what audit risk is, and we do need to keep an eye on audit risk because audit risk can also be the difference between being sued because you gave a wrong opinion and not being sued because you did the extra work to make sure that everything was appropriate in nature. the last thing that we'll talk about is audit evidence. So once we set our materiality, once we set our audit risk, then we need to go get audit evidence. And now audit evidence is the evidence that we're going to get to substantiate the management's assertions. Now, when we grab this audit evidence, it must have two things. It must be sufficient, okay, and it must be appropriate in nature. So sufficient and appropriate in nature. Let's start with sufficient. When we look at audit evidence, it must be sufficient. The amount of audit evidence that we get should be sufficient to substantiate management's assumptions, okay, or assertions. So sufficiency has to do with the quantity of evidence. How much evidence did we gather based on the likelihood that that balance would be misstated, based on the risks of that balance, based on how management puts that balance together? Do we have enough evidence to substantiate management's assertions? Okay, so again, audit evidence must be sufficient in nature. It also must be appropriate in nature. Now, appropriate in nature means that it meets two things. It meets relevant and reliability. Okay, so what's relevant? Relevant tells us that it's specific to management's assertion. So not only did we get enough, not only did we test enough AR balances, but it must be relevant to what we're trying to assert. We're trying to assert that management has that those accounts receivable balances actually occurred and they are complete. Well, if they're complete and they incur, then we must get enough evidence to sufficiently say that it has, and the evidence that we get must be relevant in nature, must be specific to the AR, which means we can't get AP information because it has nothing to do with AR. Okay, so relevant in nature, it's specific to management's assertions. Now, reliability says, can it be relied on to obtain truth in the account balance or the assertion being tested? So, is it reliable? Now, let me give you an example of reliable. Okay, let's say you are looking at the cash balance of a company. Okay, what's more reliable? Okay, management gives you a copy of the bank statement. You look at the journal entries that make up that cash amount, or you send a letter directly to the bank and the bank sends that letter directly back to you confirming the account balance. Okay? So, number one, you get the bank statement from the client. Number two, you look all the entries underlying that balance. And number three, you send a letter directly to the bank and the bank sends it directly back to you saying they're confirming the balance. Well, we know that if the client hands us the bank statement, there could be an opportunity to manipulate that bank statement. So obviously that isn't a good one. We know on the second example that looking at the underlying data doesn't tell us that it actually happened or that it is actually accurate, because they could have posted journal entries just to make their balance higher or lower or whatnot. On the third option, if we're sending a confirmation or a letter directly to the bank, they're signing off on it and they're sending directly back to us, then it is reliable. It's more reliable than the bank statement. Yes, the bank statement could have the bank logo, it could have the balances, it could have the right phone numbers, it could have everything right, okay? But there's something called Photoshop, okay? We could Photoshop all the numbers on there if we wanted to, okay? But a confirmation that goes directly to the bank and comes directly back to us is more reliable than the bank statement. Now, this doesn't usually happen, but let's say the bank is closed no longer and we're looking at a balance prior to it closing, then maybe that's the only thing we can rely on. That's better reliance than having nothing. Okay, so when we look at our audit evidence, it must be sufficient in nature. We got to have a good quantity of it to substantiate whatever we're trying to substantiate. And then it must be appropriate in nature, and appropriate means that it must be relevant in nature and reliable in nature. Relevant in nature is it's specific to what we're trying to audit. It's specific to that testing of the assurance assertions that management's giving us. And it must be reliable in nature in that, can it be relied on? Is it more reliable? Okay, so when we look at audit evidence, we got to think about, how reliable is it? Can we rely on the documents given to us? And we usually like documents that are not prepared by management. If we can get things that are not prepared by management, that's a little bit more reliable. There are some things that we have to rely on management, and we'll take that with a grain of salt, but we'll do things like retest it, re-examine it, refoot it. We'll do some things so that we can be assured. We're not just going to take their word for it, we're going to do our own testing around it to make sure that the documents that they give us are appropriate in nature and sufficient in nature and reliable in nature. Okay? And so these are the three things that we have to think about. Materiality. How material is something? Think about the $100 for the college student versus the $100 for the millionaire. One would make a difference than the other. That has to do with whether or not it would significantly affect the user's judgment in whatever they're trying to make a decision on. Secondly, we talked about audit risk, the risk that the auditor is going to give an inappropriate decision on the financial statement or an audit opinion when the financial statements are actually material in the statement. And that's the key word here, materially. And then the last thing that we talked about was audit evidence. Audit evidence should be sufficient in matter and appropriate in nature. Appropriate has to do with relevance and reliability. Is it relevant to what we're trying to test, and can it be something that's reliable in nature? So again, this lesson has to do with materiality, audit risk, and audit evidence.